So, welcome to the 90-minute webinar of the Ultimate Guide to Liquidity. Now, this is material of the Lions, and that's a community that I run. I will explain more about it later on. So, this is going to be based off of a book that I wrote called The Ultimate Guide to Liquidity. And I'm going to try and convey as much information as I can in one lecture. So, without any further ado, let's get into it. So, before we start this, everybody must understand the first division. What is liquidity, right? So, in order to best understand liquidity, then we must go to the root of liquidity. What is the root of this thing, this concept, liquidity? Well, we got to start by understanding the definition. We got to understand by understanding what we're talking about. So, what is liquidity? So, liquidity, okay, so the word liquid is something that flows. So, liquid is something that flows. So, if liquidity, as in water, flows from rivers to oceans and from oceans back to rivers, liquidity, as in the financial context, is money. Money that goes from your pocket to companies and from companies back into your pocket, or from your pocket into assets, and from these assets back to your pocket. That is in the financial context. Now, what is the word liquidity actually in the financial context, right? It's not cash in the financial context, because when you go to pay somewhere, they don't tell you we accept credit card or liquidity. They tell you we accept credit card or cash. So what is liquidity? Well, liquidity is how much cash you have available. For example, if somebody asks you how liquid are you, they're pretty much asking you how much cash do you have available. So if your portfolio is consistent of 2 houses worth $1 million and $500,000 cash, you're 66% illiquid and 33% liquid. You have 33% cash, which is liquidity, and you have 66% in assets. Now, what differs liquid from illiquid? What differs cash from assets? Why do we call them differently? The reason we call them differently is because of their ability to be exchanged. So cash is easily exchanged for anything you want. You can buy whatever you want with cash. You can buy an expensive watch. You can buy a house. You can buy cars. You can buy food. You can buy whatever you want with cash. But for example, with an asset such as an expensive watch or a house, you can't buy many things. You have to first liquidate it, exchange it for cash, hence the term liquidate, and then you can use that. Okay, so in order to make use of it, you need to first liquidate it. You need to first turn it into cash. So in the trading context, it is much similar. The contract that you have, let's just say you have a Bitcoin position, you have a Bitcoin long position. That's a contract. That contract is an asset. It's worth money, but it's not money. It's worth money, but it's not money. So that is why when you have a position, you're illiquid. And then once you close your position, you actually liquidate. So that is why when we, for example, when we hit stop orders, you hear the term liquidation. Whenever somebody liquidates a position, he's closing it. So whenever we hit a stop order, whether that be stop loss or take profit, you will see liquidations. Okay? Now, in the trading context, when people talk about liquidity, they typically refer to the stop order, specifically stop loss. So when I'll say there's a lot of liquidity in this area, I'll typically be referring to stop losses. In other words, you can just flip the words and think as if I'm saying there's a lot of stop losses in this area. Okay? That is liquidity. I hope I was very clear, and I hope everyone now understands what liquidity is.